In this lecture, we will cover the CFA Level 2 reading on corporate governance. First, a high-level remark related to this reading. Many people find corporate governance a little difficult to digest. It is very theoretical. There are no calculations in this reading. But it is extremely important because ultimately the value of a company depends on many factors, and one of those factors is the strength of the corporate governance structure of a company. Companies that have good corporate governance structures tend to be better valued relative to other comparable companies which have poor corporate governance systems. What I'll do in this particular reading is I'm going to actually take relevant excerpts from the curriculum and read out a fair bit. So the question might be, what's the value addition? My suggestion here is that you can actually treat this lecture like an audio lecture. And there are several points to remember. So there isn't much working to do here. There's just a lot of things to remember. So on your commute to work or between meetings, you can just listen to the audio and actually absorb a fair amount of material. So let's get started. Here are the 7 sections. The first introductory remark I'll make is essentially the definition of corporate governance. And this is extremely important. When you look at questions at the end of this reading, there are questions that require you to know this definition. So let's learn it. Corporate governance is the system of principles, policies, procedures, responsibilities, and accountabilities used by stakeholders to overcome the conflicts of interest inherent in a corporation. So a question might come up, what do we mean by stakeholders? In a corporate context, there are several stakeholders. The important or the major stakeholders are the shareholders. You also have the senior management of a company. So those are the 2 major stakeholders. Then other stakeholders include the regular employees. Customers are also stakeholders. Suppliers are stakeholders. But the focus of this reading generally is on shareholders and company senior executives, referred to as management. Section 2, Objectives and Guiding Principles. There are 2 major objectives of corporate governance. And again, I'll emphasize, there are several questions at the back that ask about objectives of corporate governance. And then you'll see questions where you have these 2 objectives and a third one that also looks like a very nice statement. But you actually need to memorize these 2 objectives. So objective number 1, eliminate or mitigate conflicts of interest, particularly those between managers and shareholders. And then the second objective, ensure company assets are used efficiently and productively and in the best interest of its investors and other stakeholders. So again, I'll repeat, you need to memorize this because you might see a question that has these 2, and then a third statement might be something like maximize the transparency of information or something else that sounds good. But if you have memorized these 2 statements, then you will know which one is least likely an objective of corporate governance. Next point. What are the major attributes of a corporate governance system? And here again, you need to memorize these attributes. The first one, delineation of the rights of shareholders and other stakeholders. Some students have come to me asking, what exactly does this delineation mean? All this is saying is defining the rights and responsibilities of shareholders and other core stakeholders such as senior management. At times in a given company, there might be different business units that have conflicts of interest. So defining their rights, responsibilities, etc. might also fall here. Then clearly defined manager and director governance responsibilities to stakeholders. Identifiable and measurable accountabilities for the performance of the responsibilities. So what exactly is management responsible for? What exactly is the board of directors responsible for? That needs to be defined in the corporate governance system. Fairness and equitable treatment in all dealings between managers, directors, and shareholders. Now, if I were to just make up a question on the fly over here, it would be, which of the following is least likely a major objective of corporate governance? And then I would have this item, and this item. If you are not careful, all three look reasonable. But if you have memorized these two lists separately, then you will recognize that this is an attribute of a system. It is not an objective of the system. And then compare transparency, complete transparency and accuracy in disclosures regarding operations, performance, risk, and financial position. Section 3 now, what are the different forms of business and the possible conflicts of interest? There are three forms of business. The most simple form is a sole proprietorship. The sole proprietorship is a business owned and operated by a single person. The owner of the local cleaner or the restaurant or the beauty salon or the fruit stand is a typical sole proprietor. The key point with a sole proprietorship is that there is no conflict between manager and owner, because the manager and the owner are the same person. So we will just spend a brief amount of time on this. It is not the focus of our current reading. Then a related structure is a partnership which is composed of more than one owner-manager. It is similar to sole proprietorship, except that you might have 4 different partners. For the most part, partnerships share many of the same advantages and disadvantages as sole proprietorship. Then we come to the structure that is going to be most relevant here, which is a corporation. The corporation is a legal entity and has rights similar to those of a person. For example, a corporation is permitted to enter into contracts. The chief officers of the corporation, the executives or top managers, act as agents for the firm and are legally entitled to authorize corporate activities and to enter into contracts on behalf of the business. This structure can lead to an agency problem because you have company management that is acting on behalf of the principal, which is the shareholders. And as we'll see later, it is possible that management acts in its own best interest rather than the best interest of the shareholders. The risk of this happening is called a principal agent problem or an agency problem. Here is a table from the curriculum that I would want you to learn. It is talking about the 3 forms of business and then a description of each. So sole proprietorship, sole owner, few entities. So fairly self-evident. I want you to learn this. Now a key item that I want to highlight is this item related to liability. When a company faces liabilities, or let's say that there is some legal action against a company, then the most that can be taken from the company is equal to the assets of the company. If somebody is filing a lawsuit against the company, the personal assets of the shareholders or owners are protected. So that's why we say that there is limited liability. On the other hand, with a sole proprietorship or a partnership, there the personal assets of the owners are also up for grabs, so to speak. Now we are going to get into the heart of this particular reading, the specific sources of conflict and the various agency relationships. In a corporate setting, there can be several conflicts of interest. There can be a conflict of interest between shareholders and bondholders. There can be conflicts of interests between groups within a business. But the 2 most significant sources of conflict, and the ones that we will focus on, are shown right here. The conflict between managers and shareholders, and the conflict between directors and shareholders. This term director is used for the board of directors. In general, the way the system works is you have a board of directors who represent shareholders, and depending on which textbook you are reading, that board might be referred to as the board, It might be referred to as the board of directors, might be referred to as the directors or members of the board of directors. So you will hear any term. This reading generally uses the term director. Okay, now let's consider the first major conflict, which is the manager-shareholder conflict. Here we are looking at shareholders collectively. Managers or agents are responsible for acting in the shareholders' best interest, but this may not happen for several reasons. And what are some possible reasons? What the agents or managers might want to do is expand the size of the firm without economic justification. The question is why? Very often the compensation and the perks are based on the size of the business that you as a manager are running. So does that mean that a manager has an incentive to take on bigger, larger projects even if the NPV is negative? The answer is yes, because if the manager is running a larger project, maybe his compensation will be higher. But is this good for shareholders? The answer is no, especially if it is a negative NPV project. The next is excessive compensation and perquisites. So this is fairly straightforward. Clearly, management wants to maximize salary, compensation, etc. Also, perks. Managers want as many perks as possible. Clearly, that might not add value to shareholders. So that is a potential conflict. Then the next two are more interesting. Very often, senior managers get stock options. So what that means is that the compensation structure is option-like. If you are a senior manager and you have stock options with a strike price of 25, the current stock price, let's say, is 22. What you want to do is make sure that your options get in the money. And for that to happen, maybe you have to take a lot of risk. The way you see it, if you take risk and the risk pays off, then you get a handsome payoff. If you take risk and it doesn't pay off, then you don't have much to lose because the options expire out of the money. So does that mean that you have an incentive to take excessive risk? The answer is yes. Is that a conflict between you as managers and shareholders? Again, the answer is yes. Now, another scenario, not take enough risk. Let's say that your options are in the money, but the vesting period is not over. So it will take another year before you can exercise your options. Then what is your incentive? Then your incentive might be to actually not take any risk, because if you take risk, then by the time you can actually go exercise your options, they might be out of the money. So sometimes the compensation structure might be such that that in of itself introduces a potential conflict between management and shareholders. I'm not going to do it here, but there are several interesting examples. Examples 1, 2, 3, and 4, which talk about corporate governance failures. I think these are good reads. The curriculum's favorite example is Enron. I see this at all levels across different readings. So there is a discussion of corporate governance failures at Enron. Then another one that I found very amusing. So example 2 talks about the CEO of Tyco, and I've not included it in the slides, but I'll actually read this because it's hilarious. So the CEO of Tyco, he spent $17,000 on a traveling toilet box, $445 on a pin cushion, $15,000 on an umbrella stand, all this out of corporate money, and somehow justified this. Clearly, buying a $17,000 traveling toilet box was not adding any value to shareholders. So that is just an extreme example of misusing perquisites. Examples 3 and 4 are also interesting. They are short examples. I'd say you should read them. The next conflict, director-shareholder conflict. And this is interesting. Before I go into the conflicts, I'll just make sure that you understand the structure that we are talking about here. So let's say you have a company, and the company is being run by a management team. your CEO, CFO, etc., and then obviously the rest of the employees. If you have a large company, then obviously there are thousands, if not millions, of shareholders. Those millions of shareholders cannot directly oversee management. So what happens is we have a board of directors who represent the shareholders, and then the board of directors are the watchdogs who oversee management. So at a high level, what's the risk here? The risk is that the board of directors, who should be looking out for the best interest of the shareholders, are actually very close to the management team and are maybe doing things that look out for the better interest of the management team. So that is a potential issue. And in the context of this issue, you can see that there might be a conflict between the board of directors and shareholders. So keep this in mind as we go through the next few slides. So let's look at these two bullets. So directors are the intermediaries between owners and managers. I just mentioned that. And what are they responsible for? They are responsible for monitoring the activities of managers, approving strategies and policies, and making certain that these serve investors' interests. They are also responsible for approving mergers and acquisitions, approving audit contracts, reviewing the audit and financial statements, setting managers' compensation, including any incentive or performance awards, and discipline or replacing poorly performing managers. So it's a very important watchdog role, and you can see that there will be a huge problem for shareholders if the directors are too close to managers. There will be a conflict if directors identify with managers' interests rather than shareholders. I've been saying this, but here it is now formally written. This can happen when the board of directors is not independent. So whenever you are evaluating the board of directors, the first major item to look at is whether they are independent. And independent from what? Independent from management. So when you are doing this evaluation, what is it that you look at? Some specific areas to look at to determine whether there is board member independence or not. And this needs to be done both at an individual director level and also the board overall. Does the board include senior managers such as the CEO and CFO? Very often boards do, but clearly if you have a large percentage of company executives on a board, then that automatically means that the board is not independent. Do board members have personal relationships with management? So if they do, then that would compromise independence. Do board members have consulting agreements with the company? So if the company gives lucrative consulting assignments to board members, then that also compromises the independence of board members. Interlinked boards, what this means is that you have the CEO of company A on the board of company B and the CEO of company B on the board of company A. So that's called interlinked boards, and that also compromises independence. If the directors are overcompensated, then they would like to keep their position, so that also compromises independence. Section 5, Corporate Governance Evaluation. An essential component of the analysis of a company and its risk is a review of the quality of its corporate governance system. This evaluation requires an assessment of issues relating to the board of directors, managers, shareholders. So what we are going to see is a structured approach to our assessment process. Our context here, or the hat that we wear, is that of a financial analyst who is evaluating the corporate governance structure of a given company. We, in this section, look at corporate governance evaluation in the context of the board of directors, because the biggest thing is whether the board of directors are acting independently and in the best interest of shareholders or not. And then there are several examples of corporate governance. This contains all the testable material, and then this is just practical examples of some good corporate governance systems. So let's talk about the board of directors. I've already touched upon this in section 4, but now we will do this in more details. And here again, I know this is not overly exciting, but you need to memorize the bullet points that you see on the slides. And these are taken straight from the curriculum. Boards of directors are a critical part of the system of checks and balances that lie at the heart of corporate governance systems. Board members, both individually and as a group, have the responsibility to do the following. Number 1, establish corporate values and governance structures for the company to ensure that the business is conducted in an ethical, competent, fair, and professional manner. Number 2, ensure that all legal and regulatory requirements are met and complied with fully and in a timely manner. Number 3, establish long-term strategic objectives for the company with the goal of ensuring that the best interests of shareholders come first and the company's obligations to others are met in a timely and complete manner. Continuing with the same list, the board of directors needs to establish clear lines of responsibility and a strong systems of accountability and performance measurement in all phases of a company's operation. The board is the entity that hires the CEO, determines the compensation package, and periodically evaluates the officer's performance. The board needs to ensure that the management has supplied the board with sufficient information for it to be fully informed and prepared to make the decisions that are its responsibility and to be able to adequately monitor and oversee the company's management. The board should meet frequently enough to adequately perform its duties and meet in extraordinary sessions as required by events. So the question might come up, how frequent is frequent? This depends on how quickly things change, but some boards meet every quarter. The board should acquire adequate training so that members are able to adequately perform their duties. So as you saw at level 1, you have nominations committee, you might have the audit committee, and so on. So every committee needs to have the appropriate training and qualification to perform its designated function. Now here is something that builds on what we have talked about. This is the manual for investors, and this is something you see in detail at level 3, but this is a document that has been published by the CFA Institute. I'm just going to highlight the 4 critical points. You can read this on your own, but to act in the best interest of shareholders, board members need a combination of 4 things. What are those 4 things? Independence, which is, I'd say, the most important. Then the right experience, resources to do what they need to do, and accurate information about the company's financial and operating position. And then the next slide, which actually I will want you to read, is just a little detail on each of those 4 items. And this is along the lines of what we have already talked about, hence I will not read this aloud. All right, now continuing with the board of directors, let's drill into some critical items. We've talked about the fact that they should be independent. So how do you evaluate independence? We have said that very often the board has the CEO of a company and the CFO of the company as part of the board. So that's all right, nothing inherently wrong with that. But when you are evaluating a company, you should see that at least 3/4 of the board members should be independent. This is just a rule of thumb. It's not something that is mandated by governments. This is a corporate governance best practice, that you want a larger percentage of the board to be independent. Clearly, if 3/4 of the board is either management or relatives of management, then that would compromise the independence of the board. What are factors that indicate a lack of independence? So what exactly do we mean when we say a board member is not independent? I have given the obvious example that if you have a CEO on the board, he is clearly not independent. But what about somebody who is a former CEO or a former CFO? Is that person independent? Generally, that person is not considered independent because they have close links with the company. Any business relationship, if a person is a major supplier to the company, then not independent. Personal relationships, the wife of the CEO, not independent. Interlocking directorship, we've already talked about this. Any banking or creditor relationship, that also would compromise independence. Independent chairman of the board. Now, this is an interesting item. Very often you see people with the titles CEO and chairman of the board. So it happens a lot. Recognizing that this happens a lot, the corporate governance best practice still is that the chairman of the board should not be the CEO of the company. There are actually arguments that go both ways. The argument for the CEO being the chairman of the board is that he's the person that best understands how the company is performing. But the counter argument is that if you have the CEO as the chairman of the board, he is the one that defines the agenda. So since the chairman of the board defines the agenda, ideally that chairman should be independent. And again, if you were to pick what is a best practice according to your view as an investor, then the best practice is that the chairman of the board should be independent. But again, recognize that this view is still debatable. All right, now here is a long list again of items that you need to know. What are the appropriate qualifications and core competencies that you as an investor should look for in the board as a group and as individual members? So relevant expertise in the industry, including the principal technologies used in the business and in financial operations, legal matters, etc. Indications of ethical soundness. You want to make sure that the board members have not done things that compromise their integrity in the past. Experience in strategic planning and risk management. Other board experience with companies regarded as having sound governance practice. Dedication and commitment to serving the board and investors' interest. This means that your board members should not be sitting on too many boards. And your board members should also come regularly to meetings and participate in meetings. So the opposite of this would be somebody who sits on many boards and hardly ever goes to board meetings. So that person clearly then is not looking out for the best interest of investors. Commitment to the needs of investors, for example, by significant personal investments in this or other companies for which he or she served as a director. Ideally, you want directors who also have a large stake in the company in terms of their being major shareholders. If you are trying to find whether so-and-so person should be added to the board, then what you do is look at that person's past history and see that if that person was on the board of company X, during that time did the person actually own shares of company X. Continuing with effective governance practices. Now, this is a long segment in the curriculum. What I'm going to do is take each item and just point out what I think is the most important point related to each item. Annual election of shareholders. So here's the debate. Should you elect directors every year, or should there be a staggered system? A staggered system is where, let's say you have 9 directors and every year 3 different directors are up for a vote. The argument for a staggered system is that you then have continuity. You don't have a situation where all 9 board members are being replaced. The case for an annual election is that if investors believe that all these 9 directors are getting too close to management and investors want to replace all 9 at the same time, they should be able to do that. and they can do that with an annual election. This again is debatable. They are proponents of both views, but corporate governance best practices, which generally try to figure out what's best for investors, prefer annual election. With annual election, if you as investors believe that the board is not doing the right things, then you can get rid of all of them in one fell swoop, right? So debatable, but that is supposed to be the best practice. Annual board self-assessment. This is a long segment in the curriculum. There are several bullet points, but the key point is this. The board should assess itself regularly and determine whether it is performing the right functions, whether it is doing a good job. So I'll just read out a few bullet points from the curriculum. So this review should include the following: an assessment of the board's effectiveness as a whole, evaluation of the performance of individual board members, including assessment of the participation of board members in the relevant meetings, and so on. Next item, separate sessions for independent directors. Now this is critical. We've already talked about the fact that if you have this board that consists of 9 members, clearly some will be independent and some will not. Let's say that we have a situation where you have 3 board members who are not independent and 6 who are. There will be meetings where all 9 are present, but the way human beings work, people do not like to be critical of others in their faces, right? So the better thing would be that these 6 independent board members also meet separately. If there is an evaluation of the performance of the CEO, who is one of the board members, that is much better done if the CEO is not there. So what does that mean to you as a financial analyst? When you are evaluating the corporate governance of a given company, you should see how often the independent board members meet on their own, and how meaningful those meetings actually are. Audit committee and audit oversight. This is a critical committee because the financial statements that are produced by a given company, those have to be overseen by the audit committee. So selecting the right auditor, providing the right oversight of the financial information that is being presented by companies is done by the audit committee and the audit oversight group. So this is a critical function because those are the financial statements that ultimately are going out to all investors. So there needs to be a process in place that helps investors feel comfortable that the information being presented reflects the economic reality of the company. Nominating committee, this is another big one. So this is the committee that decides on who should be nominated for these positions on the board. This committee might also be responsible for selecting the CEO. So clearly a very important committee that should be independent. In fact, this committee should only consist of members who themselves are independent. It would not make sense for the CEO to be part of the nominating committee. Compensation committee. This is the committee that decides on the compensation of the CEO and the compensation of the board members. When this committee sets compensation for senior management, what are the factors that the committee should keep in mind? Ideally, the compensation structure should be such that it is linked with the long-term goals of the company. So the compensation structure should be such that managers are incented to work in the best long-term interest of shareholders. So typically in many companies, what happens is that managers get compensated based on meeting short-term goals. But corporate governance best practice is that the compensation structure should be such that managers are compensated based on meeting long-term goals. So that is the major point here. Board's independence and expert legal counsel. Now here is another important item. Most large companies will have a legal counsel who is the main legal officer in a company. So tell me what's wrong with this situation. This legal counsel reports to the CEO of the company, and you also have the board. When the board says that they need some legal advice, then they get legal advice from this legal counsel person who has a direct reporting relationship to the senior management of the company. Is there something wrong here? There is clearly something wrong, because this person has a straight line, solid line relationship with the CEO. So it is unlikely that he'll say something to the board that is going to compromise the CEO in any way. So the best practice is that the board should have access to independent legal counsel. That's the main point over here. Statement of corporate governance policies. This is a separate slide that I will show you next. Disclosure and transparency. All this is saying is that the board needs to ensure that the statements being disclosed are transparent, in the sense that the financial information being presented by the company is a good indication of the economic reality of the company. And this is something that we have seen in the context of high quality financial reporting. So another way of putting this is that the board needs to try and ensure that the quality of financial reporting is good. Insider or related party transactions. There have been several frauds which can be traced back to improper insider transactions or related party transactions. So the board needs to put in policies and procedures that such actions should not happen. Responsiveness of board of directors to shareholder proxy votes. So the point is this: from time to time, shareholders want certain items to be put up for vote. The question is whether the board of directors takes these proxy votes seriously or not. Some of these items that are brought up for voting might be frivolous, but there might be other items which are fairly important, and you as an analyst need to see whether the board takes these important items seriously or not. If the board is not taking these items seriously, then that will put a question mark in your mind as to whether the board is really independent or not. Statement of corporate governance policies. So assess the following elements of a statement of corporate governance policies. Now, what we are saying here is that a good policy needs to be in place. Just because a policy is in place doesn't mean that everything is right, but it is an important starting point. So, is there a code of ethics that the company has? Statements of the oversight, monitoring, and review responsibility of directors include internal control, risk management, and so on. There should be a statement of management's responsibilities to provide completely and timely information, reports of directors' examinations, evaluations, and filings in their oversight, board and committee performance assessment, management performance assessment, training provided to directors prior to joining the board. So you as an analyst need to see whether these policies are in place, and then obviously you need to determine whether these policies are being followed in letter and spirit or not. All right, section 5.2 gives examples of codes of corporate governance. I'm not going to read these out because these examples simply build on what we've been talking about. And depending on how much time you have, you can go through the General Electric corporate governance principles. There is the Monetary Authority of Singapore that has put out 13 principles. This I would strongly encourage you to read because it is just 3/4 of a page and 13 short principles which summarize a lot of what we've been talking about. So do that. And then if you have time, go through example 6, which is the OECD principles of corporate governance. What this is also highlighting is that there isn't one document of corporate governance that is universally accepted and universally followed. There are some principles or there are some best practices, but then different countries or different regions might have slightly different views based on their culture, and you need to be aware that there are differences. But some central points, like the independence of the board members, that holds true across the board. One side element, which I just want to highlight here because I saw this in the practice problems at the back, is that sometimes there can be conflicts of interest between segments in a company, especially in companies in the finance sector. In a brokerage house, for example, there might be a conflict of interest between the research department and the corporate banking or investment banking group. And while not the focus of this reading, but corporate governance policies should also address how internal conflicts of interest should be handled. Section 6, environmental, social, and governance factors. These are also referred to as ESG. So investors should understand a company's environmental, social, and governance risk exposures. And what are some of those risk exposures? Legislative and regulatory risk. The point here is that companies are operating under a given legislative and regulatory framework. There is a possibility that legislation changes. So you as an analyst need to recognize what possible legislation is changing and how that will impact your target company. There is legal risk, failure to effectively manage ESG factors can lead to lawsuits. So if a company is not properly following the law of the land, then that is a risk, and it is a risk that you as an analyst need to evaluate. Reputational risk. This applies across all industries, but if you especially look at the banking industry, can you imagine the damage that can be caused to a bank if its reputation is compromised for whatever reason? So a lot of banks spend a tremendous amount of money on ensuring that their reputation is good. So you might hear the term reputation management. So you as an analyst need to figure out whether the reputation is at risk or not. Operating risk, these are actually all elements of financial risk management or risk management in general. You know, the risk of an entity being, attacked by terrorists, or, there can be a whole host of possible operating risks that you as an analyst need to evaluate. And then financial risk, so I'll read from the curriculum here. The risk that ESG factors will result in significant costs or other losses to its shareholders is financial risk. So here is the summary point for section 6. Investors are well advised to consider the possible effect of ESG factors on companies in which they invest and to carefully analyze all sources of information relevant to such risk exposures. These analyses may alert the analyst to risk factors that should be incorporated into company valuations. And finally, speaking of valuation, clearly the corporate governance structure of a company is going to impact the valuation of that particular company. The relative quality, strength, and reliability of a company's corporate governance system have direct and profound implications for investors' assessments of investments and their valuations. As we have seen in the massive corporate collapse in recent years, most or all of an investor's capital can be lost suddenly if a company fails to establish an effective corporate governance system with the appropriate checks and balances. And here again, the curriculum mentions the Enron case. What are the different risks? Weak corporate governance systems pose the following risks to the value of investments in a company. There is accounting risk. This is the risk that a company's financial statement recognition and related disclosures upon which investors base their decisions are incomplete or misleading. There is Asset risk, the risk that assets of a company which really belong to shareholders are not being properly used by management. Or another way of putting it is maybe management is misusing company assets. Excessive perquisites is an example where company cash, which is the most liquid asset, is being used for the benefit of managers and not for the benefit of shareholders. Liability risk, this is where the company might be taking on excessive liabilities, maybe to boost the cash position, but that clearly hurts the equity of shareholders. Strategic policy risk, this is the risk that managers may enter into transactions such as mergers or acquisitions or incur other business risks that may not be in the best long-term interest of shareholders. That was a fairly long reading, just a quick summary of the main points. You need to know the two objectives of corporate governance and also learn the core attributes of an effective corporate governance system, and make sure you don't confuse the two. Put them in two different parts of your brain, because there will be every attempt in the exam to merge the two and confuse you. The three major business forms: sole proprietorship, partnership, and the corporate structure. The focus of this reading is the corporate structure. The issue with the corporate structure is that the management and ownership is separate, and that creates a potential agency problem. A critical group within this corporate structure is the board of directors. So you need to understand the responsibilities and the relevant competencies. The most important aspect that you need to look at when you are evaluating the board of directors is independence. So make sure you recognize that. Then we talked about effective corporate governance practices. So there was a long list of items that you need to try and remember. My word of advice that if you have trouble remembering, then what you do on the exam is just think of yourself as an investor. And if there is a set of choices, then look at it as an investor. So look at which option is best for the investor. Right? Ideally, you should learn everything on these slides, but sometimes that's not always easy. Then we talked about ESG. So this is becoming increasingly important for investors to worry about. And finally, valuation implication simply says that several studies have shown that when corporate governance is strong, that has a positive impact on the valuation of companies. As always, go over the summary, review the learning objectives. The examples are not overly testable. If you have time, read them. Examples are simply reinforcing the points that have been made. Practice problems are interesting. There are several practice problems which are good. And in the practice problems, there is actually some calculation. And I'll warn you up front. The calculation is in the sense that when you talk about corporate governance, you want to do things. The board should do things that are in the best interest of shareholders. So there is a scenario where a company needs to select a capital structure. If there are 3 or 4 different capital structures that can be selected, which is the best one to select? The best one to select is the one where WACC is minimized and the overall value of the firm is maximized. So that combines the concept of good corporate governance with material that we have seen in earlier readings. So do the practice problems as always, and if you have time, then do questions from other sources as well. That is it.